Hello, everyone. We're really thankful that you all were able to join us today. I'm sure you are still trickling in as my clock just turned to 12 o'clock Eastern time right now. But just wanted to go ahead and introduce our speaker today. We do have Meb Faber joining us. And if you're not familiar with him, he is the portfolio manager at Cambria Investment Management, where he manages equity and global tactical asset allocation portfolios. He is a frequent speaker and writer on investment strategies and has been featured in Barron's, the New York Times, and the New Yorker. He has written 6 books, over a dozen white papers, and is the host of the Meb Faber Show Podcast. He graduated from the University of Virginia with a double major in engineering science and biology. He is also the man behind the Idea Farm, a world-class research that's available to retail investors. And we just got through a really brief introduction about Sky on Paw Patrol. So if you have any questions about that as well, you can save those to the end. But without further ado, I'd like to go ahead and introduce Meb, and we will have Lauren Adams, another board member today, moderating our session. So go ahead.
Awesome. What's up, everybody? Happy Tuesday. If today's Tuesday, every day feels like a Tuesday in the quarantine in 2020. The good news is we still have 3 months left. 2020 is not over yet, guys. 25% of the year still to come. Anyway, this will be fun. I'm going to kind of whir through this as usual. Sad I'm not in Detroit today. Had planned on being there a prior summer. Wanted to catch a ball game. So you guys, let's put that on the schedule in the future. High on my to-do list. Never been to the city. Here's a picture of my local spot, Manhattan Beach. If you guys are ever in town, we can do a 6-foot hello or closer, depending on what's going on in the world. But what we want to talk about today is not just for the next 3 months, but really for the next few years. How do you prepare your portfolio for any outcome? And if 2020 is any indication, it's a good reminder that any outcome is possible. We like to say normal market returns are extreme and normal markets are an average. So a tale of two tales, the good, the bad, everything in between. Let's get started. All right, since you guys joined us today, you get to go download our free books, a special offer for you guys. Just kidding, you can download them at any time, mainly because I have a major tiff with Amazon. But I think you can download these 4 right here. They're all free if you go to CambriaInvestments.com. Also, the podcast is free. The blog is free. Over 2,000 blog posts, over 200 podcast episodes. Keep you busy during quarantine. Good excuse to get away from your family or spend some time together and listen to my beautiful monotone. Just a quick background on who we are, what we do. I manage Cambria, ETF issuer. We just launched our 12th fund. No one crazy enough to launch a real estate fund in a pandemic, but we are. But everything we do is under this banner of quantitative and rules-based. We'll briefly mention 2 today as we go through this presentation, but you can find more, CambriaFunds.com. Here's a roadmap. What are we going to talk about? The current market environment, what's going on in the world. Also, how to prepare for the right tail, AKA a melt up. We're close to all-time highs here in the stock market. And then the left tail, what happens if everything implodes? This year has been an odd one. We had a bear market, fastest ever from all-time highs to bear and vice versa. But what happens if it gets worse? And of course, Q&A. You guys can ask me anything. Hopefully we'll get lots of time for that. So how do we prepare for the future? As we all know, the future is unknowable. That's kind of the definition. But as a useful guide, everyone loves to look back to history. I think you have to be a market historian to at least come up with a fundamental anchor on what the world looks like. And so for the main asset class that we all love to allocate to, US stocks, how should we project what they're going to do? And most people, the simple way they do it is they just extrapolate into the future. But as looking in the rearview mirror, a wise choice at all times. So y'all know I like to talk about long-time followers, valuations. In this case, we have the Shiller-Cape ratio, which is much maligned. People's brains start imploding, stop working when they talk about the Cape ratio, but it's nothing more than valuation, a long-term PE ratio. In fact, it's been around for 100 years. A lot of people don't know this. Since the time of Ben Graham, who proposed using a 5 to 7 year price to earnings ratio smooth to come out with a little more signal from the noise. to tamp down the variability of 1 year earnings. This year would be a great example, and to really come up with the extremes. And so going back to 1900, you can see that at times it's been as high as the 30s and 40s, and at times as low as the single digits. You hit the two big daddy bubbles of the 20th century, then roaring 20s, and of course my favorite bubble, the internet.com, peaking at a value of 44. And then of course you had the meltdown going into the dot-com crash, run up, global financial crisis, crash, and then this nice romp right back up to the low 30s again. Historical average down around 17. The historical average in low inflationary times, as well as the historical average the last 40 years, has been around 21, 22. Why does that matter? Does it matter? A lot of people says it doesn't. Someone asked me today, do valuations matter anymore, Meb? And I said, what's the alternative? Not to pay attention to valuations? That seems fundamentally unwise. There's no other area of investing, whether it's your house, your car, baseball cards, where you say, you know what? Valuation doesn't matter. I'll just pay whatever. So how should we think about it? The way you should think about valuation is the same way a gambler, people don't like that word, but a speculator, one who knows what he's doing in Vegas or playing poker or blackjack, who knows the odds. And that means there's a spectrum of all future probabilities. You're not guaranteed to get one return. If anyone's played roulette, if anyone's flipped a coin, if anyone's sat down at the blackjack table, you know there's random variability. So how should we think about it? Well, it turns out the most famous buy and hold index investor of all time, the great late John Bogle, proposed a formula in the 1990s where he said it's actually pretty easy to forecast stock returns. He wouldn't use the word forecast. He would use maybe expectations. But he says there's only three variables. It's the starting dividend yield, which is known right now, that's 2%. Then you add on earnings or dividends growth, which historically has been around 6%, or 5%, excuse me. Which for the nerds out there, you can split out into inflation and real dividends growth. And then lastly, change in valuation. So you can plug those in today and kind of come up with a good expectation of what the world's going to look like 10 years hence. So dividend yield, I'm going to be an optimist. I'm an optimist and say 2%. We know what the valuation is. This is lower than it actually is because I haven't updated this for last week. What's going on in the market today? I don't know. Let's say 30. And then you can come up with all sorts of scenarios where it ends in 10 years. We model out the lowest it's ever been as well as the highest it's ever been in the US. And then the most likely scenarios is back down to the average for full period back to 1900 as well as low inflation. And you can see what that valuation headwind or tailwind has. And so in the cases of going back to 21 or 17, you have a valuation headwind of 4 to 6% per year as multiples contract, which means that 10-year stock returns nominal are 1 to 3%. Not something to jump up and down about, better than bonds, of course, not negative, you know, so you can't go on CNBC and pull out your hair and gnash your teeth and say, oh my God, the market's going to crash. It's going to go down 90%. Well, this just means it's going to be positive, but not very positive. Can't say it's a bubble, just low expected returns. Now you have to at least envision the possibilities that stocks sail through average and go down to low multiples that they have been in the past, that people are willing to pay of 5 or 10, in which case you're looking at pretty nasty stock returns of 4 to 10% per year. You at least have to consider that. While unlikely, it is a possibility. And the flip side, that stock multiples stay flat, in which case you're looking at about 7% returns, and then stock multiples go up. What would cause that? I don't know. Elon Musk finds diamonds on the moon, something else on Mars, back to all-time highs in the US, and that gets you 11% per year. What's the problem with this? The problem with this is that if you look at every single investor expectation survey all around the world every year, everyone expects 10% returns. So 10% returns for stocks mean you not only have to have multiple staying where they are, they have to go up. And in fact, go up to nearly some of the highest it's ever been. And in fact, the latest survey for US investors said that they were the highest expected returns in the world at 15%. Let that sink in. And many people who are listening may be scoffing and laughing at that. But I guarantee you, go have some conversations with your clients and their expectations with everything going on in the world, the Robinhood, the SPACs, the Portnoys, every single bit of euphoria going on. Ask them what their expectations are. You may be surprised. But are the chances of that likely? They are not. So what do we say? We like to get the boring, depressing stuff out of the way early. Take your medicine. Have measured expectations. Bogle, before he passed, said 4% for U.S. stocks. So it's not just me. So what do you do about it? What happens if the market keeps going up? Do you just close your eyes, hold your nose, own U.S. stocks, Amazon calls? What are you going to do? Follow Masayoshi-san? Just keep buying calls and everything? Well, the good news is the U.S. isn't the only stock market in the world. There's over 45 investable countries all the way around. As the U.S. keeps going up, it gets to be a bigger part of the pie. We used to do this chart and it was 50%. Now it's up to 58. And the rest of the world makes up the remaining 42%. But the interesting part is if you ask investors in the U.S., and we used to do this for years, and then we stopped because the answer was always the same, out of their U.S. stock allocation, they usually allocate about 80% to U.S. stocks. And that is a massive, massive overweight, a very active bet. God bless you. You have been in the exact right place the last 10 years. So good for you. Pat yourself on the back, but now take a step back and reassess. Does it make sense to have that much of a massive overweight U.S. stocks? Particularly because everyone does this around the world, and you will come up with a laundry list of why you are justified in having an overweight in U.S. stocks. This is charts a couple years outdated, which is why it shows the U.S. at only 50, but it's directionally correct. And what it's trying to show, and this is from Vanguard, is that every country around the world, everyone puts most of their money in their own stock market. Our Canadian friends, happy Thanksgiving, by the way, our Brits, our Aussies, Japanese buddies, all of them put most of their money in their own market. And it's for all the reasons that U.S. investors, they feel comfortable, they understand the companies, they have a sense of security about what's going on, yada, yada, all the way down the list. If you talk to U.S. investors in particular, you hear some funny statements like stable geopolitical scene. I don't think anyone would probably make that argument now, but they normally do. Rule of law, yada, yada. None of these arguments hold water. Particularly as a good example as you go around the world, ask your friends in Russia, Brazil, Greece, UK, Japan, Canada, Australia, are you happy you put most of your money in your own market for the past 10 years? And they'd say, heck no, that was a really stupid decision. Concentration is not rewarded in this scenario. And if you look at valuations, we haven't updated this to this quarter. It doesn't make any difference because this is long-term. Valuations are a very blunt tool. These things play out. We get investors all the time asking us, hey, Meb, why is this or that working or not working in the last quarter, month, year? These things play out not just years, but decades. So here you have US versus the rest of the world valuation ratios. And there's two surprises, I think, to a lot of people. One is people say, no, Meb, if you look at the right side of this chart, you have a massive valuation gap. We wrote an article called The Biggest Valuation Spread We've Seen in 40 Years. People say, no, Meb, US is allowed to be more expensive. Laundry list of reasons. And I say, well, if that's true, what do you expect the historical value premium to be? And people come up with a number. And I say, well, the answer is zero. Historically, the US versus the rest of the world, there's zero value premium. They both have a CAPE ratio average to 1980 of around 22. And you can see they zig and zag. There's times that foreign's been more expensive as recent as not even 10 years ago, pre-financial crisis. There's times US has been way more expensive now, the global financial crisis. But look at the 80s. You had this massive bubble dominated by Japan. And the historians on this call will remember this, where Japan hit a CAPE ratio of almost 100. This wasn't some backwater economy. This is, at the time, the largest stock market in the world. It's still a top 5 stock market and economy. And hit the biggest bubble we've ever seen. And it's taken 30 years for Japan to work that off, which is astonishing. the U.S., and it's not really not shown up here on the chart, is so extreme, largely because this is world ex-U.S. So Japan was only a fraction of that. But look back, there's times the U.S. has been really cheap, just not right now. So this big alligator jaws, you know, if you ask people, if you even go back 70 years and people say, no, Meb, the U.S. is compounded over 1% more than foreign stocks. There's no reason to invest in foreign stocks. And I say, how much of that outperformance do you think has come since 2009? And the answer is all of it. Okay, so people extrapolate. They love to be myopic. What happened this past decade? Extrapolate to the moon. U.S. stocks are going to outperform forever. We have a pinned tweet. I think it's still there if you go to my Twitter account, that talks about the top 6 research pieces on the past year about investing in international stocks. And one is from Bridgewater, who's having a rough year. But they put out a fantastic piece that showed that U.S. stocks versus GDP weighted or average weighted of countries all the way going back to 1900, it's incredibly rare for a U.S. stock market to outperform the average. It's happened this past decade, happened in the 90s, but before that, you would have to go back to 1920 for the U.S. to be the outperformer. So extrapolating this fairly rare event is probably a foolish idea. So the good news is the U.S. is expensive. So global valuations, U.S. is around 30. Again, not a bubble, not terrible. The great news is the rest of the world is much cheaper. Foreign developed is down around 20, which is altogether reasonable value. There's a big spread within foreign developed, of course, but this is the average. Foreign emerging down in the low teens. And for those who love to see me poke, I'll trigger a lot of my value follower friends. I say I put my whole son's 529 and 401k into foreign stocks, and particularly emerging if I can help it, and particularly emerging value if I can help it. But the cheapest of the cheap is, if you take the bottom quartile of countries, has a CAPE ratio down around 10. Now, we measure all sorts of long-term valuation metrics. We measure sales, book, cash flow, dividends. Actually, it doesn't matter. You could do the same examination with any of these metrics, and they should come up with similar conclusions. Value is a blunt tool. It plays out over a decade. If you are a geography buff, you'll be able to recognize these 5 flags. These are currently the 5 cheapest countries in the world. We update this once a quarter, but you can find a lot of cheap countries trading in the single digits. So much of this just has to do, by the way, with the P in the PE. How much is the country down? So many times the cheapest valuation bucket is simply that it's down 40, 60, 80% already. And the things that are expensive are hitting all-time highs. So we're not gonna spend much time on this. We're just saying we have a fund that does this. We like to show that we have skin in the game. I put my money where my mouth is. I invest all my public net worth into our funds. It always surprises people, but most mutual fund managers have nothing invested in their own funds. And so disclosure, you can find more information about this fund online at Cambria Funds. But this is what I wanted to point out. So this is a chart of valuation metrics. And by the way, you don't have to believe me. And this is a fun experiment, because you can go and do this at Morningstar. You can type in any ETF, mutual fund, click on holdings, and it'll show you a summary of the underlying characteristics of the fund. In this case, I just wanted to show you our fund, GVAL, which invests in 12 of the cheapest countries around the world. Super simple, rebalances once a year. But comparing it, not just for CAPE, but these are all the Morningstar metrics for earnings, book, sales, cash flow, free cash flow, dividend yield. If you're a dividend person, 100% of these are cheaper than the S&P 500, as well as cheaper than the category too. And I think the category is what, foreign SMID. And so you have this scenario where if you're looking at margin of safety, if you're looking at just whatever it may be, and let's be clear, value has been garbage for not just the past few months, but for the past few years, and has been a big headwind versus tailwind. But that's the way multiples work, right? They get stretched. You get this opportunity where no one wants most of these countries. And the good news is, if you're an allocator, you don't have to go buy a bunch of single country ETFs. Last thing a client wants to see is, what in the world are you doing buying Colombia and Russian funds in my account? That's insane. Whereas you get all of them into one fund. But just going to show, you can pull this up for income. And we love to tell people to go do this for the dividend funds as well. You'll be surprised at just how expensive a lot of the dividend funds are in the US and how low the dividend yield actually is. So if you think of a melt up, there's a bit of safety in buying the cheapest stuff. Now, you shouldn't expect the drawdowns to be lower, but over time, historically speaking, and this has been backed up by research that GMO and PIMCO and others have done, has shown that the higher valuation you pay for a market, the higher chance you have of a big fat drawdown in the next 1 to 5 years, just because it's just weight. Valuations have a way of causing that to turn into big losses. So if you want to prepare for the melt up, you should at least diversify, move away from the US stock market, which is one of the most expensive in the world. And it's also half a world market cap. If you're a US investor, you probably put 80% in the US. So think about that. Diversifying into global stocks, particularly those with cheaper valuations, we think is a prudent thing to do. What happens if things get worse? So back in March, we wrote an article called Investing in a Time of Coronavirus. And it was a part of a 4-part series. It was the Get Rich portfolio, the Stay Rich portfolio, how I'm investing in a time of coronavirus, and how I invest my money. And what was important about this is the one we wrote in March, Investing in a Time of Corona, laid out this possibility. The world was going insane. It felt like the zombie apocalypse. And we said, look, you have to at least prepare for the bull case and the bear case in stocks. Not just today, and this is for always, but today in particular. And so we laid out a scenario where we said, look, there's a bull case where treatments are developed, fiscal monetary policy is aggressive and effective, hospitals aren't overwhelmed, a vaccine is in progress and developed, and people in general handle the pandemic well, which, despite your political views, we said at the end, if this happens, stock market will be hitting all-time highs by year end. And people were like, that's crazy. There's 0% chance of that, Meb. We're down 30%. Many asset classes, small cap value is down 50. Real estate, commodities, I mean, lots of weird stuff happened in 2020. We said we also have to prepare for the bear case from there, where the virus mutates, you have new cases, policies aren't effective. And in March, this seemed like the more probable outcome, by the way. And the problem with most people is they don't prepare for all the possible outcomes. I mean, look what's happened in 2020 already. And damn it, we still have 3 months left to go, and including an election. But we had a world where if you were to tell me, he said, I'm going to give you guys a crystal ball. If I was a Detroit CFA last fall, and I said, here's what's going to happen in 2020. PMI is going to go from expansionary to contractionary. Fed's going to reduce interest rates from 2.5 to 0. You're going to have unemployment go from 3 to 15%. Gold's going to be hitting all-time highs, setting records. Oil at some point will trade negative. Where do you think stocks are going to be? And I think most people would go down the long list, 20, 40, 60, 80% down. Almost no one would probably say an all-time high. So you have a bit of this Main Street sort of Wall Street decoupling. How long does it last? Does it last forever? Is it the scenario where the US stock market is just looking to the future? We're going to get past this, romping and stomping, possibly. But you have to consider the flip side now on the downside, just like you had to consider the upside in March. So we often tell people, as you think about risks, as you think about US stocks in particular, we wrote a paper called Worried About the Market many years ago that outlined this theory. We said, first of all, if you say US stocks, how do you hedge any risk? Well, first of all, you just don't take it in the first place. If you have 100% of your portfolio in US stocks, well, maybe not own 100%, maybe own 80 or 60. Second, there's things you can do with your portfolio to tamp it down. We mentioned diversifying into foreign stocks, particularly with the tilt towards value. You can diversify into other assets. The things historically that have not helped in a downturn, like foreign stocks, in real estate, in commodities, didn't help again this year. The things that usually help, gold, bonds, absolutely help this year. Gold is a little unreliable. Sometimes it helps a lot, sometimes it doesn't. Bonds help most of the time, but usually not as much. You could do active strategies. For those that have followed us for a long time, know we're fans of trend following. And lastly, one that's almost guaranteed to help by structural, the way that it's built. Can't say guarantee ever in investing, of course, but is a tail risk strategy of buying puts. So let's talk about that. We have a fund that does this, again, just to illustrate that we're not making all this up. And the way we think about it, we want it to be simple. So much of the inverse sort of ideas and categories is so complicated. I couldn't explain half of them. They're often so very expensive too. So we said, what's the simplest way to think about tail risk to a traditional stock portfolio? Say, let's put 90% in US government bonds. Historically, that's been a great diversifier that gets capital appreciation like it did in 2020 when it hits the fan. And with the rest, we can buy a ladder of puts, say from 3 months all the way out to 12. So this is an example of what the fund has done since inception. The top line is the S&P, romping and stomping near all-time highs. Then you got cash, then our fund, and then the bear market category. There's a couple takeaways, and you can see that the tail and the strategy of buying puts paired with bonds has a nice inverse zig and zag, as does the bear category. The problem with the bear category, though, you hedge during the bad times, but in the good times, you usually give it all back. And if you zoom in on just this year alone, you can see that. So going into the massive dump for U.S. stocks in March, you can see that cash held up, obviously didn't really have much returns, but both the tail ETF as well as the bear market category did great. Now, the challenge of the category, though, again, is it ends up looking like an inverse fund. So here you have yourself, wow, we had great protection. Next thing you know, you're down 20 on the year. And then that's really frustrating. And that makes the challenge of insurance and hedging really hard in practice. Clients look at these statements and they see stocks are going to go up over the long term, historically over periods of 10, 20, 30 years. And that's the whole point of hedging, by the way, is to get to the finish line. You want most of your portfolio at risk. You want to own businesses. You want to own stocks, preferably with tilt towards value and global, like I mentioned. But you want to make sure and ensure that people survive it. And the challenge with a lot of the inverse hedging type of strategies is they make it hard. They often tend to go down every single month. And that feeling as a client or an allocator is difficult. And to be clear, I think that a strategy like ours will be a cost over time. Gone are the days of 4 to 6% interest rates where that income is a nice buffer. But you have to, just like you have to consider U.S. stocks hitting a bull or bear, you have to at least consider the possibility that U.S. bonds trade negative. And they didn't teach me this growing up in university. I don't think they taught anyone. Even 5, 10 years ago, people would say, you're crazy if you're talking about this. But let's be clear. Most of the world's government bonds already are negative. Many countries around the world are already dealing with this issue. And so as you have to think about that, that's something you have to at least consider in modeling out, that you would have capital appreciation and it gets you into trouble once you're trading at negative. I do expect these tail strategies to be a cost. And there's like 3 ways people bucket these. By the way, like everything, fees matter. This fund is the cheapest fund in the category. All 12 of our funds are cheaper than the category average, but this one is happens to be the cheapest. And to be honest, that's less of a comment that this is like a dirt cheap fund, Vanguard style. It's more just everything else is so expensive. And talk about one more thing as we think about risk. And this comment, let me be clear, is anti-consensus. Almost no one I know believes what I'm about to talk about. So we're a little bit crazy, but I want you guys to at least end this webinar by with something to chew on, because I think it's important. And it's important not just for the advisors, but really anyone, and applies to their life. So if you think about it, let's say you're a financial planner, you're at the local wirehouse. Let's think about how levered you are to the stock market. First of all, you own stocks in your own portfolio. And because that portfolio, whether it's 60-40, whether it's balanced, but let's say it's 60-40, that volatility of stocks dominates bonds. So really it's more like 80-20 or 90-10. So stocks dominate the volatility of that portfolio and the outcome. 2, if you're a financial advisor, it's fee-based. You're exposed to your clients owning stocks, which means if stocks go down by half, your fee revenue goes down by half. Third, as we all know, think back to March, it was probably too fast for it to happen, but the more and more stocks go down, the crazier clients behave, and not just clients, everyone. So think back. I mean, I still have conversations this day where I talk to investors and say, I sold Meb in the financial crisis. I never bought again. So people panic in bear markets. So you have a bear market, your revenue goes down even more. Lastly, if you don't work for your own company, they often downsize. Look at all the layoffs going on this year across all industries, but you may lose your job. So we often tell people, you're not just 1 times leverage the stock market, you're essentially 4 times leverage the stock market. And one way to think about it, you could make the argument you should own no US stocks, but who's going to do that? That just doesn't sound reasonable. So thinking about hedging that risk to balance out, and a good way to think about this is we say, look, airlines, they hedge the cost of fuel, the main risk to their business income stream variability. Cereal companies hedge the cost of wheat. We come from a Kansas, Nebraska farming background. That's a very real world consideration. Prices of ags been beaten down over the past 5 years, maybe showing some signs of life today. We'll see. You guys in the same part of the country probably can relate to that. But in every other part of your life, people understand risks and hedge them. You own car insurance, you own house insurance, probably home insurance, maybe renter's insurance, you got a life insurance, all these things. But most people don't hedge the possible really negative outcomes of stocks in the portfolio. Why is this particularly important? Tying back to the beginning of this, because of valuations. And look, things could keep romping and stomping. All-time highs by themselves are not bearish. They're actually bullish. The trend is up. But if you were to go into the quadrant box of US stocks, cheap, expensive, uptrend, downtrend, the best is a cheap uptrend. The worst is an expensive downtrend, historically speaking. But the second best is expensive uptrend, which is where we are now. The problem comes when that flips from expensive uptrend to expensive downtrend, whenever that may happen. It gets really, traditionally a bowl full of pain. So I'm going to start to wind down so I can stick around for some Q&A and chat about whatever. But things to think about, summary of this, reminders. The first, market valuations are stretched. There's no question. Snowflake just came out at 200 times revenue. You're starting to see quite a bit of euphoric behavior, the SPAC mania going on right now, everything else happening. This is just usually symbolic of markets when they're at all-time highs and going up even more. So the prudent thing to do, think about expectations, talk to your clients, say, hey, look, we're expecting 1% to 4% on US stocks, 1% on bonds. You can't add those together and get 8%, friends. You can't add them together and get 10%. God forbid 15%. So at least tamp down your expectations. And if you want to be a little weird, or at least be average, normal, you can start to allocate to foreign markets, particularly the cheap ones. We often tell people just to get to 50-50. By the way, most people don't know this. US as a percentage of world GDP is only a quarter. So thinking about valuations, I think is going to be one of the dominant trends of this decade. Second, hedge the possible outcomes. We often say to people that as they think about a tail risk strategy, there's sort of 3 buckets where people use it. The first being they put it in this like weird alt bucket. They just throw everything: market neutral, long, short, trend following, managed futures, tail risk. Second is they use it as sort of a tactical or all the time insurance. There's like, I want something green when everything else is red. And lastly, as a bond substitute. And what I mean by that, I don't mean a direct bond substitute, but if you have 60-40, maybe you take 10 or 20% out of your bonds because you get your bonds again with the tail risk strategy because it's 90% treasuries. But you essentially get the overlay as well. So it brings down and by the way, I've neglected to mention this, but at least the way ours is designed is we're targeting a roughly 1 to -1 return approximation with US stocks. So if US stocks go down 10% tomorrow, we'd broadly expect the strategy to be up about 10% and lose less in the good times. So all those tail risk ideas I think are going to be increasingly interesting as investors struggle with this concept of US bonds at 70 bips, 20 bips, zero, negative. So you want to be ahead of the trend and think about, how do I approach that part of the portfolio if and when this does occur, and also to at least allow my investors to survive and get to the finish line, which is the long-term goal, right? If you got all these ironclad, emotionless Spock investors, good for them. You don't need these sort of things. You can just put the stocks in a lockbox and forget about it. But most of us are human and can't handle it. Lastly, we didn't touch on this much, but the number one determinant, we just wrote a piece on the blog yesterday called "The Investment Implications of a Trump or Biden Presidency." And that's just a little lead. You guys got to go to the blog and see it, because the takeaway is not what you would expect, but I'm going to hint here, which is a big impact on your portfolio is mostly on costs, not just expense ratio, but taxes as well. But it's something that a lot of people don't spend too much time thinking about. I will wind down here, kick it back to you guys, and stick around for any and all questions.
Wonderful. Thank you, Meb. My name is Lauren Adams, everyone, and I'm a board member of the CFA Society of Detroit. I would like to invite all the audience members once again to submit questions via the Q&A box. While we give folks a few moments to do that, I want to quickly plug Meb and his podcast. It is how I first came across his work, and it is highly entertaining and informative. So I've also enjoyed reading his books, including the Ivy Portfolio. So just wanted to give him a quick plug there. And with that, let's get to some questions. All right, so first up, should tail risk strategies be a permanent part of a diversified portfolio? And if yes, what is the best way for advisors to get clients to stay the course when it underperforms potentially for years?
Again, this is a bit of an anti-consensus question, and we answer. It's a great question. We get it a lot. Anti-consensus answer. I probably own tail risk personally and on our company's balance sheet. So you see a lot of news lately where Jacket Square and the MicroStrategy crew started buying up Bitcoin. And that gets a lot of press, but extending my philosophical thought experiment, if you're an asset manager or personally, you could argue A, that you shouldn't own any US stocks, but no one's going to do that. But B, that you should absolutely consider hedging. And so I own a huge chunk personally, as well as my company. We've disclosed this over the years, and earlier this year, well north of 25%. I think it's closer to almost 50 for my company. But how do most people use it? It's really the three ways that I mentioned before, which is an all the time insurance. They just want some behavioral feel good. You know, if you think back to March, you guys remember we were watching the futures overnight, markets would be limit down, and it just feels better to see that you have something green when literally everything would be red on your screen. It's just hard. And so to have something that behaves during those times, hopefully is worth it. We see some people, again, as a bond substitute, and some people use it tactically. They say, look, I think stocks are expensive or going down based on stochastics, whatever. And so they'll trade in and out. And for the really crazy people, you could short it too. You want a short option exposure, that'll give it to you. But it's been good to see the history of performance chasing in public markets. My biggest fear was that everyone would buy it after the event in March. And that didn't happen. We've seen a lot of flows this summer. I think as people kind of touch on that sort of Main Street, Wall Street disconnect, they don't feel like necessarily markets should be at all-time highs and at high valuations given where we are in the world. Lordy B, as my grandma would say, we still have 3 months to go and an election mixed in there. So people use it in different ways, but I like to use it as a sort of just all the time allocation.
Great, thank you. Another question is, with bond yields near 0%, how does that affect the discussion about comparing, long-term keep ratios compared to stocks 50 years ago?
So, there's a lot that's changed over the years, and you always got to be wary on, is this time different? We talk about this in our shareholder yield discussion, where investors who still focus solely on dividends are missing part of the picture that now that buybacks have become a much bigger chunk of how companies distribute cash flows. And so much in the same way, you have to say, look, have reasons for valuations changed, have structural components like accounting rules in different countries. And there's absolutely some impact. But the way to think about valuation is not, should the CAPE ratio be 28 or 32 or 30? It should be 30 or should it be 5? And if you're ever doing this sort of valuation work to 2 decimal points, we say that you're approaching it the wrong way. It's a blunt tool where you just want to know if you're in the right universe, the right galaxy, right? And so we say that, you know, the difference between the US and the rest of the world is literally a 50% difference in valuations in the emerging markets and emerging markets value. The good news is even within the US, it sort of waxes and wanes, large caps versus small caps, value versus growth, and it changes over time. You know, I think the way that interest rates impact is actually through inflation. And so the CAPE ratio adjusts for inflation. The one difference is that people are willing to pay a higher multiple when they feel safe and cozy with interest rates in that 1% to 4% safe zone. And that applies to all markets. So if you get north of 4% inflation or you get less than 1% inflation, so you work into deflation, multiples fall off a cliff. We're in that safe zone now, so the low 20s is probably okay, but it's not 30. And so, yes, there's sector influences too. The US has more tech than the rest of the world, yada, yada. But again, over time, the big thing about valuations is not just about buying the cheap. It's also about avoiding the really expensive. And to me, that's the beauty of fundamentals. It gives you an anchor from whence to say, again, for the longtime listeners who have followed us back a decade, you guys would have remembered when I was talking about being in Colombia and in Colombia trading at, you know, a plus 40 CAPE ratio. And it's now I think down around 10. They haven't invited me back, but I'm trying to get them in Bogota if you guys are listening. Because I said, your market's really expensive. I hate to say that because I'm here and I love you guys. This is a beautiful country, great food. But it's expensive. And now I want to go back and say it's cheap. The problem is you go around the rest of the world, you know, so many people think only in terms of the US and say, well, interest rates are low. This is like Buffett says this, it drives me crazy. He says interest rates are low, therefore stocks look better in comparison. That doesn't hold true for the rest of the world. If that were true, with bond yields at 0 and negative in the rest of the world, stock valuations should be at 50 or 100, but they're not. They're the opposite. They're down at 12. So the challenge being is that this plays out over a long-term period. So when you guys have me back in 2030, we'll go see a ball game in person, hopefully have some beers, and we'll see if it worked out or not.
What do you think a catalyst would be for U.S. stocks to underperform foreign?
Catalysts are always obvious in retrospect. You know, I graduated university during the last great internet bubble, and you had all the telltale signs. My professors were trading stocks during class, literally. These are engineer professors. They have no business trading stocks during class. Day trading, checking quotes during class. We didn't have phones, so they're on their computers. All these things going on, and eventually just the weight. It's like if you build a sandcastle, a drip castle down at the beach, you build it, and eventually just the way the castle crumbles, and the whole thing comes falling down. Historians always are able to give the catalyst in hindsight, in retrospect. I think it's challenging to be able to identify just one. You know, I have a tweet from the end of last year, and I say, you know, it's interesting. Decade ends often mark inflection points in markets. So the 1980s mark the end of the end of the 70s, mark the end of the inflationary regime, the beginning of the U.S. monster secular bull market. The 80s ended with Japan at the biggest bubble we've ever seen. The 90s ended with the dot-com bubble. The 2000s ended the financial crisis. I wonder what the 2020s are going to bring. And lo and behold, I was surprised that it was going to make itself revealed in the first 3 months, which is what a global pandemic but that was obvious, certainly after it's happened. And we'll all look back and say, well, this is what the pandemic, the effects it had for a month, a year, 10 years. So the short answer is, I don't know. But we'll all look back and say, oh yeah, that was obvious. When the Vision Fund said they're going to start listing SPACs, oh, that was obvious. All these, XYZ behaviors, or whatever the election holds, who knows, or the pandemic. But as far as one specific event, Franz Ferdinand, who knows? I'm not one to predict, other than the fact that it's just wait.
Mm-hmm. Looking at your slide on global valuations and the cheapest and the foreign emerging, how do you think about the future COVID risk within the cheaper potentially emerging economies versus developed economies?
Well, let me put on my doctor epidemiology hat. I'm, despite what this presentation sounds like, I'm the world's biggest optimist. I think I see more innovative work going on in startups my friends are working on and investing in. I've invested in over 200 private companies at this point. We didn't talk about any of that today, but you can find more info in my article about how I invest my money. I believe in the relentless march of human progress. And so I believe therapies will be developed. I believe the world will go back to normal sooner than later. And we'll all celebrate, hopefully, as soon as next summer. During the deep, dark days of the pandemic, I had a couple questions on some podcast guests where I say, when's the next time you think you're going to see live music? One guest was a big music fan, and he's like 22 or something. And, depressing as that sounded, I got to see some live music this summer. Well, I was in Wyoming, and we were all socially distanced, but I got to see it. So my point being is that, you look back and my favorite investing book, Triumph of the Optimist, shows this progress over a century in capitalism. There's a great book, I think it's called Americana. I've been reading about just the massive benefits that have accrued over the past century, and reading about the development of the automobile and radio and flight and everything that's gone on. Who knows what we're going to be talking about 50 years hence. But the point, the 20th century had horrific after horrific event, right? So like world wars, Spanish flu, we already had a pandemic. And so eventually it rights itself. And when it does, I think you could just face massive tailwinds, whether it's 3 months, whether it's 6 months, whether it's 18, but eventually this too will pass. And when it does, I think the particularly emerging markets, deep value in the global space is really going to run.
This one had a couple comments on it. The first is, how do you recommend people use the ETF tail in a portfolio? You've touched a little bit on that already. The way that this participant uses options would be to offset some notional of a client's portfolio, but to hedge 100% stock portfolio, which would require margin. So it seems the benefit is muted as opposed to developing your own tail risk strategy.
It depends. Look, people can do it on their own. I mean, we like to say, people love to email us and say, Meb, why didn't you put gold in there? Why did you use a ladder of puts instead of front month? Why is it slightly out of the money versus yada? There's 1,000 permutations. When we launch funds, there's 4 criteria. First one is it can't exist, or if it does exist, we think we can do it much better or much cheaper. So when we designed this strategy 4 years ago, I said, look, there's nothing I want to invest in to use personally, so we're going to design it and launch it. Second was that it has to be based on some academic and practitioner research. So we usually build it out, publish a paper or book. In this case, it was a paper. Third is it has to be something I want to put my own money into. So eventually you have to settle on something, some methodology. There's probably 50 ways of doing this that are just fine, including not doing it at all. We mentioned you don't need tail insurance necessarily, but for many, it helps. And so we settled on this methodology. I think it's the best for me and the way to do it. Lots and lots of advisors don't want to be mucking around with options for clients. Forget just the fat finger risk. It's clients don't understand them. All of a sudden you got to talk about puts and derivatives. Can't put them into retirement accounts, all the way down the list. but absolutely you could do it on your own, and not pay us to do it. I think it's more capital efficient. Again, if you own government bonds, you simply take the government bonds out because you get government bonds again here, and then you get the overlay. And so, if you had a 60-40 portfolio and you take out 20% of the bonds and 20 percentage points and sub in this, you essentially take the 60% stocks down to 40, and you have the same bond exposure. Anyway, there are a million different ways to use it. If we don't cover it today, hit me up, email me, call me, and we can talk about it more.
Awesome. What do negative government yields around the world outside the US tell you about the health of the global economy?
This is an area that no one cares about besides me for some reason. The largest asset class in the world is foreign bonds. And if you talk to the average advisor, I know almost zero, it's got to be less than 10% that own foreign bonds. And as you describe, for a pretty good reason, which is they have no yield, in some cases negative yield. Now, just like we often talk about, market cap weighting in stocks is extremely suboptimal because it doesn't use valuations. Indexing in bonds globally doesn't make sense either because it's often weighted to the countries with the highest debt issuance. And so we wrote a paper on this. We have a fund, one of my favorite funds, one of our smallest, called Sovereign Bond Fund. It invests in the sovereign bonds around the world with the highest yields. So it takes top third. And for a while, the US was in this bucket, which is crazy to think about. It's like the US, Mexico, Brazil, Russia, it's Argentina. But the point being is that historically, tilting towards carry, which is kind of like tilting towards value or dividends in stocks, gives you a tailwind of 1% or 2% performance. But again, it goes back to this idea of it's not just about investing in the cheap stocks or the high yielding bonds. It's about avoiding the expensive ones or the ones with negative yield. And so if you're going to do bonds, we say, one way to think about it is adding this global exposure. Now, right now, it looks a lot like emerging markets-ish, which isn't always the case. If you look at the Global Value Fund, it's a mix of developed and emerging. Right now, it looks more emerging market-y, but you get this sort of 3, 4, 5, 6% yield versus 0 to negative, which is a pretty nice cushion over time. But yes, it is not a sign of the patient being a clean bill of health.
What about the idea about U.S. companies and U.S. government having a much stronger focus on stock prices and the performance of the stock market versus the rest of the world? Does that command a premium in valuation?
Well, if we've learned anything about markets in history, it's that politicians and no one party can really impact markets for long. I mean, you've seen story after story of people trying to corner or influence markets, and they can do it for a short amount of time, but even Mr. Bezos doesn't have enough money to really move around markets for an extended period. And usually, if you try to, you end up on the wrong side of the stick. So look, we could get into another 2 hours now of policy ideas and how I believe that we should be encouraging an entire generation of not just Americans, but people all around the world to learn to be investors, to take the reins of their portfolios and ride along the backs of the best scientists and entrepreneurs all around the world by investing. I think that part's a good thing. Focusing purely on stock prices and on day trading and on, what's going on, a lot of the Robinhood trading, I think is the wrong lesson. You want to be investing in businesses like the Warren Buffett concept, right? You want to be tagging along on this march of human progress, but that plays out over decades, not days, minutes, weeks. And so the focus by politicians, we actually have an article and a podcast coming up on this with our friend Joel Greenblatt, where we're talking about policy ideas. And there's a lot. I absolutely don't want to run for office, but hopefully maybe can give some good ideas that will encourage everyone to become investors and reduce this wealth and income gap we have in our country. But one of the ways of doing it is by building a base of everyone benefiting and being a part of this fantastic system of capitalism and free markets, and encouraging more, not less, entrepreneurs and investors as well.
Staying on the topic of government, what do you see as the risk of massive government deficits and what appears to be unlimited amounts of monetary policy?
Well, that's I like you work that in at near the end of the hour. It's hard. And I think one of my least popular tweets, I have a take where I say, here's a laundry list, you can find it on Twitter somewhere, of things that Meb believes that the vast majority of professionals don't believe. And on that list is, I think the Fed's done a pretty good job, and no one on the planet, there's zero compliance with that tweet. It's hard. I think we don't have time, literally, for how the depth of this discussion. The good news is that markets eventually account for what's going on, and the money will go where it's best treated. And you find this all the way around the world, where you have dysfunctional governments and policies and tax regimes, et cetera, et cetera. You even find it in microcosm in states, where certain states will have incentives. There's nothing humans love more than following incentives. And you have certain programs that encourage certain behavior and nudges. And going back to the last comment about policy, I mean, the Australia pension fund, where it nudges you into saving 10% of your income every year, has resulted in the best pension fund system in the entire world. So I'm hopeful that monetary and fiscal policy sort of rights itself. We got a lot of ideas. We can talk about the freedom dividend, variants of universal basic income, all sorts of retirement concepts, lockboxes, forever fun. But you guys have to have me back. We just got too much to talk about.
Awesome. Maybe this one's a little bit closer to the wheelhouse, but the thresholds which thresholds do you use to define what quadrant the market is in for uptrend, downtrend, and cheap and expensive?
Yeah, that was a very basic. This article is probably 5 years old, but I think it applies universally, not just to the U.S., but to every market. I think we use the example of something like a long-term moving average, so maybe a 10-month moving average, which goes back to our old paper in 2006. Same as the daily, which would be the 200-day moving average. Really doesn't matter. We wrote a new paper, by the way, that no one read because I think it came out in February or March, but it was about investing in markets at all-time highs. And it says, buying a market at an all-time high, is that a good thing? No, it's a great thing. You can find it on the website. Different takeaway than most would think. But the valuation, I think, was simply is like, is the CAPE ratio above its long-term average at the time, or is it below? Nothing rocket sciencey, just like, are you in the right part of the galaxy? And historically speaking, it works great. But again, the problem with a lot of these is it requires, we talk a lot about buy and hold and then other strategies, whether it's value, whether it's trend. And buy and hold is just fine. And you're going to look the most like your neighbors all the time. So it's great. It's low cost nothing in 2020, which is fantastic. The challenge is buy and hold, much like the risk we were talking about, has its worst moments when the economy is having its worst moments. So think 2008, when it's all hitting the fan, the economy is imploding. Well, that's when your portfolio does worse. Theoretically, you would want it to be the opposite. You want your portfolio to be doing well when times are bad. And so it's, trying to implement some of these active strategies make a lot of sense, but it's hard because you can be different. The value guys can certainly identify with this for the past decade, the trend followers as well. So having a balance, a little bit of both, we call it going halvesies, I think is a reasonable approach to where you're not binary, all in or all out in just one allocation.
Okay. Well, I think that's just about all the time we have today. Thank you so much for joining us, Meb.
It's been a blast. We'll have to do it again. If listeners, if I didn't get to your question, you want to talk about it, shoot me an email, hit me up, come say hi in LA at a distance, and we'll have to do it again.
Awesome. And thank you to everybody for joining us at the CFA Society of Detroit, and we look forward to seeing you at our next event. Thanks again.